Stop scrolling. United States just failed a financial stress test and almost nobody noticed. Not a crash, not a default, something worse. And by the end of this video, you'll understand why your money is already being taxed without a single vote being cast. When you hear the words credit downgrade, your brain probably shuts off. It sounds boring, technical, harmless. That reaction is exactly why this moment is so dangerous. Credit downgrades don't explode overnight. They quietly rewrite the rules underneath the entire economy, and that rewrite has already begun. Think of a credit rating as a trust score, not politics, not opinions, just trust. When trust drops, borrowing becomes more expensive. When borrowing gets more expensive, everything built on debt starts to crack. And the United States is the largest borrower in human history. This downgrade is not about America going broke tomorrow. No one seriously believes the Treasury is about to miss an interest payment. What this really is an early warning siren telling global investors that America's long-term financial path is drifting off course, and the data backs it up. Just 5 years ago, the U.S. paid roughly $500 billion a year in interest on its debt. Today, that number has more than doubled. Not because the economy doubled, not because incomes doubled, but because the cost of debt exploded. Interest is the one bill you can't escape, refinance, or inflate away. Here's where it gets uncomfortable. When U.S. credit weakens, the impact doesn't stop at the government. Banks hold massive amounts of Treasury debt. So do pension funds, insurance companies, and the entire financial plumbing system. When trust weakens at the foundation, everything built on top of it begins to vibrate. Not collapse yet, but shake. And here's where you've been misled. People say, relax, treasuries are still safe. Everyone still buys them. That's true for now, but safety isn't binary. It's a gradient, and we just slid down another notch. Credit ratings don't force mass selling, they change behavior. Investors pause, they hedge, they quietly demand higher returns. And when millions of investors do that at the same time, interest rates move, volatility increases, and confidence erodes. That erosion doesn't stay on Wall Street. It leaks into mortgage rates, auto loans, credit cards, and business financing. You don't read about it in headlines, you feel it in your monthly bills. Now, here's the real problem. America's debt isn't rising during emergencies anymore. It's rising during good times. Low unemployment, stable growth, yet borrowing like the crisis never ended. That's not stimulus. That's addiction. And the scariest number almost no one talks about is this. More than a third of all U.S. tax revenue now goes just to interest payments. Not roads, not defense, not healthcare. Just servicing past promises. This is a silent tax, and it compounds every single year. Ratings agencies aren't just watching spreadsheets, they're watching Washington. Endless extensions, no offsets. Mandatory spending, nobody touches. Political gridlock dressed up as stability. Markets don't care about speeches. They care about credibility. This isn't a cliff edge collapse, it's a slope. Every downgrade is a small step downward until one day confidence doesn't come back when policymakers ask for it. That's how financial earthquakes actually begin quietly, gradually, and then all at once. The government can raise its debt ceiling. You can't. Higher rates mean higher costs and less margin for error. This downgrade isn't about America's reputation. It's about how much pressure households can absorb before something snaps. The collapse doesn't start with panic, it starts with trust draining away. And once trust is gone, the math takes over. That process has already started. In the next video, I'll show you who benefits from this slow erosion and who gets wiped out first, because every financial earthquake creates winners long before it creates headlines. Subscribe so you don't miss it. This story is only getting started. ChatGPT.